Hello everybody, this video is the overview of income statement. Um, I will discuss income statement in general and discuss about the usefulness, limitations, and quality of earnings. I will go over the format of the income statements in which I will discuss the elements, intermediate components, condensed income statement, single step income statement. I will also talk about the various income statement items, how they are reported, like unusual gains and losses, discontinued operations, extraordinary items, non-controlling interests, and earning per share. I will also talk about the other reporting issues like accounting changes and errors, retained earning statements, and the comprehensive income. So stay tuned. Now let's discuss what an income statement is. The income statement, also the profit and loss statement, is a report that shows the income, expenses, and the resulting profits and losses of a company during a specific time period. The income statement is first financial statement typically prepared during the accounting cycle because the net income or loss must be calculated and carried over to the statement of owner's equity before other financial statements can be prepared. The income statement calculates the net income of the company by subtracting the total expenses from the total income. This calculation shows the investors and the creditors the overall profitability of the company as well as how efficiently the company is at generating profits from total revenues. The income and expense accounts can also be subdivided to calculate the gross profit and the income or loss from operations. These two calculations are best shown on the multi-step income statement. The gross profit is calculated by subtracting cost of goods sold from the net sales. Operating income is calculated by subtracting operating expenses from the gross profit. What is income statement used for? It's important to note that there are several different types of income statements that are created for different reasons. For example, the year-end statement that is prepared annually for stockholders and potential investors doesn't do much good for management while they are trying to run the company throughout the year. Thus, the interim financial statements are prepared for the management to check the status of operations during the year. Management also typically prepares departmental statements that break down revenue and expenses by business segments. In the end, the main purpose of all the profit and loss statements is to communicate the profitability and business activities of the company with end users. Each one of these end users has their own use for this information. Let's look at who uses the P&L and what they use it for. There are two different groups of people who use this financial statement: internal users and external users. Internal users like company management and board of directors use this statement to analyze the business as a whole and make decisions on how to run it. For example, they use performance numbers to gauge whether they should open a new branch, close a department, or increase production of a product. External users like investors and creditors, on the other hand, are people outside of the company who have no source of financial information about the company except published reports. Investors want to know how profitable a company is and whether it will grow and make more profitable in the future. They are mainly concerned with whether or not investing their money in the company. Creditors, on the other hand, aren't as concerned about profitability as investors are. Creditors are more concerned with the company's cash flow and if they are generating enough income to pay back the loans. Competitors are also external users of the financial statements. Competitors use the P&L to gauge how well other companies are doing in their space and whether or not they should enter new markets or try to compete with other companies. So in a nutshell, we can say that the income statement is used to evaluate the past performance, to predict the future performance, and it also helps assess the risk or uncertainty of achieving future cash flows. There are some limitations related to the income statement. The companies omit items that cannot be measured reliably. Income is affected by accounting methods employed, and income measurement involves judgment. Quality of earnings. Companies have incentives to manage income to meet or beat Wall Street expectations so that the market price of the stock increases and the value of the stock options increases. Quality of earnings is reduced if the earnings management result in information that is less useful for predicting future earnings and cash flows. Earnings management is the use of accounting techniques to produce financial reports that present an overall positive view of the company's business activities and financial position. Many accounting rules and principles require company management to make judgments. Earnings management take advantage of how accounting rules are applied and creates financial statements that inflate earnings, revenues, or total assets. One way that the management can manipulate the income statement is to change the accounting policy that generates higher earnings in the short term. For example, assume a furniture retailer uses last in, last out method to account for the cost of inventory items sold, which means the newest units purchased are sold first. Since inventory costs typically increase over time, the newer units are more expensive, and this creates a higher cost of sales and a lower profit. If the retailer switches to first in, first out method, the company sells the older, less expensive units first. FIFO creates a lower cost of sales expense and a higher profit, so the company can post higher profits in a short term. As discussed earlier, the income statement calculates the net income of the company by subtracting the total expenses from the total income or revenue. Revenue is the inflow or other enhancement of assets or settlement of its liabilities that constitutes the entity's ongoing major or central operations. Some of the examples of the revenue accounts are sales revenue, fees, interest income, dividend income, and rental income. Sales revenue is the income that the firm realizes from selling its products or services to the public. Usually, sales are the net sales that the firm achieves minus the cost of returned merchandise. Expenses. Expenses are the outflows or other using up of assets or incurrences of liabilities that constitute the entity's ongoing major or central operations. In other terms, the expense is a cost of an asset used by a company in its operations to produce revenues. Simply, we can say that the expense is the use of assets to create sales. Notice that I didn't say it's the amount of money spent to generate sales. Expenses are created when the asset is used up, not when the cash is paid out. For example, depreciation expense. Some of the examples of the expense accounts are cost of goods sold, depreciation, interest expense, etc. It's important to note that the expense account is the contra equity account that has a debit balance. This means that the equity is decreased as the company generates more expenses. This only makes sense since expenses lower the net income or profits of the company. There are some other elements that are reported on the income statement. Gains. Gains are the increases in the equity, that is the net assets, from the peripheral or incidental transactions. Losses are the decreases in the equity, that is the net assets, from the peripheral or incidental transactions. The gains and losses can result from sales of investment or plant assets, settlement of liabilities, or write-offs of the assets. Now, why the gains and losses are different from revenues and expenses? The revenues and expenses belong only to the operating activities of the company, the day-to-day operations. And the gain and losses reflect the non-operating activities. Usually, they belong to the long-term assets and liabilities. When the long-term asset is sold, for example, the investment or plant asset, there's a gain. Now that gain is not reported with the revenues, it's reported separately, and you will see this distinction in the multi-step income statement, where there are two sections, the operating section and the non-operating section. And in the operating section you will see the revenues and expenses, and in the non-operating sections we'll separate the gains and losses from the non-operating activities. Now here is the example of the multi-step income statement. See, on the top there is the operating section that is separated from the non-operating section, which comes below the operating section. The operating section has sales, and then the net sales are derived by reducing the sales discounts and sales returns and allowances. We reach at the gross profit by deducting the cost of goods sold from the sales. Out of the gross profit, we deduct the selling expenses and the administrative expenses. Now, all these expenses that you see are the operating expenses. Selling expenses are directly, in some way, directly associated with the sales, and administrative expenses are indirect costs of doing the business. Then we come to the income from operations. And you see that below income from operations, there is a small section that says other gains and losses. Now, this is a section where we will report the gains and losses that do not belong to our daily operations, but the company received dividend revenue and they are reporting it separately. The company has a passive income. Maybe it has rented a building to some third party and they're receiving rent. So that's the passive income that was reported in this section. Then there are other expenses and losses like interest on bonds and notes. And after lining them up, you come to the income before income taxes. So there is a reason why the operating section and non-operating section is listed separately, which we will discuss later on. So once you reach to the income before income taxes, you deduct your income tax out of it and you come to the net income for the year. This is the example of the condensed income statement. If you compare it with the multi-step income statement, you will see that the selling expenses and the administrative expenses are given as a one number. So it's not much detailed as compared to the multi-step. You see that in the single step income statement, there is no implication that one type of revenue item has priority over the other. So in general, the single step income statement just emphasizes the total revenues and total expenses. Reporting various income items. This section is very important. It is heavily tested in the CP exams. The companies are required to report unusual and irregular items as a part of net income, so users can better determine the long-run earning power of the company. These items fall into four categories: unusual gains and losses, discontinued operations, extraordinary items, and non-controlling interest. An unusual gain or loss is an abnormal gain or loss that is typically unrelated to the business's ordinary operations. In other words, this is a gain or loss that normally would not occur in a day-to-day operations of the business. The unusual characteristic is the first requirement of an extraordinary reporting item. In order for an unusual gain or loss to be considered an extraordinary item, it must be both unusual and infrequent. This means that the gain or loss happened outside of the company operations and will most likely never happen again. Now, the example of the extraordinary item is the unlikely natural disaster, for example, an earthquake in Philadelphia. Philadelphia doesn't get earthquakes because the fault lines aren't near the state. Thus, if you have a business and it was hit by an earthquake and the building collapsed, it would be considered an extraordinary event in Philadelphia. But if you take California, where the earthquakes are not very rare, if you have a business in California, then if the building got collapsed, then that event will not be an extraordinary event. Extraordinary items are reported in a separate section of the income statement because it allows the creditors and the investors to look at the operations separated from these one-time occurrences. If the unusual gain or loss is only unusual and not infrequent, it should be reported in the continuing operations section after the normal revenues and expenses. This way, the users of the financial statements see that it could be a frequent event, but it most likely will not happen regularly. So you see there is a slight distinction between extraordinary items and unusual gains and losses. The extraordinary items must be both unusual and infrequent, and they are reported separately into the extraordinary item section. But if the item is frequent but not unusual or the other way, then they are reported into the continuing operation section after the normal revenues and expenses. Here are some of the examples of the unusual gains and losses. The following items may need separate disclosure in the income statement: losses on the write-down or write-off of assets, gains or losses from the exchange or translation of foreign currencies, restructuring charges, other gains and losses from the sale or abandonment of property, plant, and equipment, effects of strike, adjustment of accruals on long-term contracts. Discontinued operations. Discontinued operations are essentially the portion of an entity that no longer functions within the core business units or product lines of the entity and is reported separately on the income statement. Now, while these activities may still generate profit for a business, they are classified as discontinued operations within the financial statements of the entity to ensure the external users do not inappropriately evaluate the profitability of entities' continued operations. based on them. Businesses must allow a set of strict accounting rules that require them to disclose the details of all ceased operations, as well as any impact on the entity's financial statements. Companies often cancel product lines, dispose of equipment, sell market segments, and shift their business models. All of these structural changes result in discontinued product lines, profit centers, or business units. Businesses must present a clear definition of the portion of the business that is discontinued and a clear indication by management that the discontinued operation is absolutely no longer part of the entity's core business or continued operations in the financial statements. This helps creditors and investors what is reoccurring and what activities will end. So that means that the income or losses from the discontinued operations are reported separately from the operating income on the income statement because it consists of earnings from a segment of the business that no longer exists, and that amount that is reported net of tax. Here you can see that the discontinued operations are reported after the income from continuing operations. Without a discontinued operations, this line over here will be the net income. So income from continuing operations, and then below comes the discontinued operations. Now let's see a few examples and try to identify the extraordinary items. Number A. A large portion of tobacco manufacturers' crops are destroyed by the hailstorm. Severe damage from the hailstorms is the locality where manufacturer grows tobacco is rare. So yes, because that hail is rare in that portion, so that is an extraordinary item. B. The citrus grower's Florida crop is damaged by frost. Now we all know that Florida is a state where the oranges and citruses are grown. So if the crop is damaged by the frost, everybody knows the conditions over there. So that's not an extraordinary thing. C. A company sells a block of common stock of a publicly traded company. The block of shares, which represents less than 10% of publicly held company, is the only security investment the company has ever owned. So the key word is only security investment the company has ever owned. That's why it's the extraordinary item. Now here you see the income statement and you see where the extraordinary items are reported. If you go in the red section, the first line item is income from continued operations before income taxes. Under that is the discontinued operations. Then comes the income before extraordinary item, and then you see the extraordinary items, the loss from earthquake, and after that is the net income. On this slide we see non-controlling interest, which is one of the elements of the income statement. A non-controlling interest, also called NCI or minority interest, is an ownership position where a corporate shareholder owns less than 50% of the outstanding shares and can only influence management's decisions instead of controlling them. What does non-controlling interest means? Applying this concept to the corporate owners, a non-controlling interest is the ownership interest in a subsidiary company, which is owned by outside investors and not the parent company. Generally, the minority interest in the subsidiary company is less than 50% of the total number of shares outstanding. The parent company reports the financial results of the subsidiary company on its consolidated balance sheet to present a claim on assets by minority shareholders or in its consolidated income statement as a percentage of profits belonging to the minority shareholders. Minority interest shareholders have less influence on firm's management and policies, and restricted voting rights, but they offer significant growth for the firm with their experience and capital. So, when the parent company owns a substantial interest, generally greater than 50% in other company, GAAP requires that the financial statements of both companies be consolidated together into one set of financials. The non-controlling interest is the portion of the equity or the net assets interest in the subsidiary not attributable to the parent company. Here you see the income statements of Poquito Industries, and these are the consolidated income statements. So the numbers that you see on the right hand side are the consolidated numbers. And if you see the net income, that net income shows the income from the parent company and also from the subsidiary. So it's a combined number. Out of that combined number, the net income allocated to the minority interest is subtracted to give the net income allocated to the stockholders of Poquito. Now let's spend a few minutes on this slide. This is a summary of the various incomes that we have discussed previously, and we'll go over it one more time. So the first type of situation is unusual gains and losses, not considered extraordinary. Criteria: it has to be material, character typical of the customary business activities, unusual or infrequent but not both. Examples are write-downs of receivables, inventories, adjustments of accrued contract prices, gains or losses from the fluctuations of foreign exchange, gains or losses from the sales of assets used in business. And where are they placed on the income statement? Show in a separate section above income before extraordinary items, often reported in other revenues and gains or other expenses and losses section. Not shown net of tax. It's very important because the tax is calculated after on the income from continued operations. Now the second one is discontinued operations. Criteria: disposal of a component of business for which the company can clearly distinguish operations and cash flows from the rest of the company's operations. One example is food distributor that sells wholesale to supermarket chains and through fast food restaurants decide to discontinue the division that sells one of two classes of the customers. And where are they placed on the income statement? Show in a separate section after continued operations but before extraordinary items, and they are shown net of tax. Third is the extraordinary items, material and both unusual and infrequent. That's the difference between extraordinary items and unusual gains and losses. So for the examples of the extraordinary items are gains and losses resulting from casualties and expropriation or prohibition under the new law. They are shown on the income statement as a separate section, extraordinary items, and they are shown net of tax. Fourth is the non-controlling interest. Allocation of the net income or loss divided between two classes. The majority interest represented by the shareholders who own the controlling interest, and second, the non-controlling interest, often referred to as the minority interest. And it's placed on the income statement below the net income, reported as a separate item below the net income or loss as an allocation of net income or loss, not as an item of income expense. Earning per share, EPS, also called the net income per share, is a market prospect ratio that measures the amount of net income earned per share of stock outstanding. In other words, this is the amount of money each share of stock would receive if all of the profits were distributed to the outstanding shares at the end of the year. Earnings per share is also a calculation that shows how profitable a company is on a shareholder basis. So a larger company's profits per share can be compared to a smaller company's profits per share. Obviously, this calculation is heavily influenced on how many shares are outstanding. Thus, a larger company will have to split its earning amongst many other shares of stock compared to the smaller company. The formula is earnings per share is equal to net income minus preferred dividends divided by weighted average common shares outstanding. You will see that the preferred dividends are removed from the net income in the earnings per share calculation. This is because the EPS only measures the income available to common stockholders. Preferred dividends are set aside for the preferred stockholders and can't belong to the common stockholders. Most of the time, the EPS is calculated for the year-end financial statements. Now, types of the accounting changes. GAAP establishes the generally accepted accounting principles for the following changes. A. Change in accounting principle. A change from one generally accepted accounting principle to another generally accepted accounting principle that is more preferable. B. Change in accounting estimates. A change in a prior period estimate resulting from additional information, more experience, or a new event. And C. Change in reporting entity. Change in the entity being reported, such as change in the subsidiaries, including the company's consolidated financial statements. In addition to these changes, GAAP also establishes the accounting principles for correction of errors. Now, methods of reporting and accounting change. The two possible methods for the company to disclose an accounting change or error in its financial statements include retrospective application or adjust the change prospectively. Retrospective application of a new accounting principle means restate the financial statements of prior years, sometimes referred to as a retroactive adjustment or a restatement. B. Adjust for a change prospectively, prospective adjustment. Accounting for a change in accounting principle. A change in accounting principle may be voluntary change from one generally accepted accounting principle to another, or a mandatory change because FASB has adopted a new principle. A change in accounting principle also includes a change in the procedures used to apply the accounting principles. Common changes in accounting principles include changes in inventory cost flow assumptions or revenue recognition methods. Once a company adopts an accounting principle, the principle should not be changed unless a preferable principle is adopted. The jurisdiction of the change should be clearly disclosed in the notes to the financial statements. A company accounts for a change in accounting principle by the retrospective application of the new accounting principles to all prior periods. The cumulative effect of the changes to the new accounting principles, net of income taxes, is shown as an adjustment to the beginning balance of the retained earnings, with corresponding adjustments to the carrying values of the assets and liabilities that are affected by the change. The company then uses a new accounting principle on its current financial statements. The financial statements for the prior periods are restated as if the new accounting principle has been applied in that period. The company's disclosure include a nature and the reason for the change, and the description of the prior period financial statement information that was retrospectively adjusted. The effect of the change on the income, earnings per share, and any other financial statement line item that was retrospectively adjusted, and the cumulative effect of the changes in retained earnings at the beginning of the earliest period presented. If it is not practicable to retrospectively apply the new accounting principle to prior period, a company should apply the new accounting principle as if the change was made prospectively as of the earliest date practicable. When the change in the accounting principle has both the direct and indirect effects on the company's income, only the direct effect of the change in accounting principle is included in the retrospective adjustment. Any indirect effects are included in the year in which the accounting change is made. The retrospective adjustment method enhances the comparability because the financial statements are prepared using the consistent accounting principles. Now, the major disadvantage of this method include confusion caused by changing the prior year's financial statements, inconsistency with all-inclusive concept of income, because adjustments are made directly to the retained earnings and bypass the income statement. Adverse impacts on the company's contractual agreements and the possibility that the company's management may attempt to manipulate income by excluding the items from the current year's income statement. A company accounts for a change in accounting principle at the beginning of the first interim period, regardless of the interim period in which it makes the change. Accounting for a change in an estimate. A change in accounting estimate normally results when uncertainties are resolved as new events occur, more experience is acquired, or as the new information is obtained. Changes in estimates are given prospective accounting treatment. That is, the company adjusts the current and future financial statements to reflect the new estimate. Prior year's financial statements are not adjusted for changes in accounting estimates. The prospective treatment reduces comparability because results reported in the years before the changes are based on different estimates than the years after the change. If a change in accounting estimate cannot be distinguished from the change in accounting principle, example, change in the depreciation method, it is considered a change in the estimate affected by the change in accounting principles and is accounted for prospectively. Now, talking about the accounting for a change in reporting entity, the third type of accounting change is the change in accounting entity that occurs when a company presents consolidated or combined financial statements in place of the financial statements for individual companies. B. There is a change in the specific subsidiaries that make up the group of companies. Or C. The company included in combined financial statements change. The company accounts for the change in reporting entity by retrospectively adjusting the financial statements so that all of the financial statements are presented for the same entity. This approach improves consistency. Accounting for the correction of an error. Errors include mathematical mistakes, mistakes in the application of accounting principles, oversights, and intentional misstatements of the accounting records. FASB statement number 154 requires that a company account for the correction of the material error made in previous periods as a prior period restatement. The correction of an error, net of the related income tax effects, is reflected as an adjustment to the beginning balance of the company's retained earnings for each period presented, with corresponding adjustments to the carrying value of the assets and liabilities that are affected by the error. This method is similar to the retrospective application of a new accounting principle discussed earlier. Errors may affect only a company's income statement or only its balance sheet or both financial statements. Errors affecting only the classification of either income statement or balance sheet items can be corrected without journal entry because the particular financial statement item only needs to be reclassified. Errors that affect both the income statement and the balance sheet can be classified as counterbalancing or non-counterbalancing. Counterbalancing errors are automatically corrected in the next accounting period as a natural part of the accounting process. The correcting journal entry is necessary for any counterbalancing error that is detected before it has counterbalanced. If the error is discovered after it has counterbalanced, no correcting journal entry is necessary, but the financial statements should be restated so that they are not misleading. Non-counterbalancing errors are those that will not be automatically offset in the next accounting period. A correcting journal entry is necessary for non-counterbalancing error, and any applicable financial statements must be restated. Now here is a summary of accounting changes and error that we have discussed before. Type of situation, changes in accounting principle. Criteria, change from one generally accepted accounting principle to another. For example, changing from LIFO to FIFO. Placement on income statement. Recast prior year's income statement on the same basis as newly adopted accounting principle. Shown net of tax. Number 2, changes in estimates. Normal, recurring corrections and adjustments. Examples are changes in the realizability of receivables and in inventory, changes in estimated lives of equipment, show change only in the affected accounts in current and future periods, not shown net of tax. Number 3, correction of errors. Mistake, misuse of facts. Examples are error in the reporting income and expenses. How to treat it? Treat as prior period adjustment. Restate prior period's income statements to correct the error. Shown net of tax. So the only item situation in which it's not shown net of tax is the changes in estimates. Now this slide shows us the retained earnings statement as the net income flows to the retained earnings. The retained earnings are increased by net income, change in accounting principle, and prior period adjustments. Retained earnings can decrease by net losses, dividends distributed, change in accounting principles, and prior period. Now let's talk about the comprehensive income. Comprehensive income is a net change in equity for a period, not including any owner contributions or distributions. In other words, it includes all revenues, gains, expenses, and losses incurred during the period, as well as unrealized gains and losses during an accounting period. In this sense, it gives external users a full view of all accounts that affect equity during the period. You can think of the comprehensive income as an expanded version of the net income. Since net income only accounts for the revenues and expenses that actually occurred during the period, external users don't get a complete view of the company activities behind the scenes. For example, net income does not take into account unrealized gains or losses because they haven't occurred yet. This means that any market adjustments for available for sale securities are not reflected in the net income on the income statement. Thus, the income statement doesn't include these numbers. Instead, the investors and creditors must look on the statement of stockholders' equity, a combined statement of comprehensive income, or a second separate income statement if they want to see the effects of the unrealized gains or losses on the equity. These reports list all of the unrealized gains and losses that took place during the year and show how they contribute to the overall equity balance of the company. So you know that the companies must display the components of other comprehensive income in one of the two ways. Number one is a single continuous statement, one statement approach, or two separate but consecutive statements of net income and other comprehensive income. That is the two-statement approach. Here you see the two-statement approach. You see that the comprehensive income statement is given as on the bottom of the regular income statement. Now let's study some of the similarities and differences between GAAP and IFRS. Relevant fact: similarities. Both GAAP and IFRS require companies to indicate the amount of net income attributable to the non-controlling interest. Both GAAP and IFRS follow the same presentation guidelines for discontinued operations, but IFRS defines the discontinued operations more narrowly. Both standard setters have indicated a willingness to develop a similar definition to be used in the joint project on the financial statement presentation. Both GAAP and IFRS have items that are recognized in equity as a part of comprehensive income but do not affect the net income. Both GAAP and IFRS allow a one-statement or two-statement approach to preparing the statement of comprehensive income. Here are some differences. Presentation of the income statement under GAAP follows either a single-step or multi-step format. IFRS does not mention a single-step or multi-step approach. In addition, under GAAP, companies must report an item as extraordinary if it is unusual in nature and infrequent in occurrence. Extraordinary items are prohibited under IFRS. Under IFRS, the companies must classify expenses by either nature or function. GAAP does not have that requirement, but the SEC requires a functional presentation. IFRS identifies certain minimum items that should be presented on the income statement. GAAP has no minimum information requirements. However, SEC rules have more rigorous presentation requirements. IFRS does not define key measures like income from operations. SEC regulations define many key measures and provide requirements and limitations on companies reporting non-GAAP/IFRS information. Under IFRS, the revaluation of property, plant and equipment, and intangible asset is permitted and is reported as other comprehensive income. The effect of this difference is that application of IFRS results in more transactions affecting equity, but not the net income. This video covers a lot of material, so it's very important that you review it again and again and again. I know it's a lot of information, but you will get hold of it. Happy learning. Thank you. Bye.